$813 billion in a single quarter. The bankers are officially pricing out new yachts, Maya.
Hold on. Read the fine print. Deal volume is actually down 22%. This isn't a broad recovery. It's just a few massive whales.
Oh, come on. When one of those whales is Paramount and Warner Brothers combining for $170 billion, you have to admit the Megadeal is back.
I'll admit their antitrust lawyers are about to buy yachts too, but we really need to look at why Washington is suddenly waving these monsters through. The rundown. So MasterCard is dropping up to $1.8 billion on BVNK.
A stablecoin startup in 2026, just when you thought corporate crypto was dead.
It isn't dead, Nate. It just put on a suit. They're buying compliance infrastructure, not Dogecoin. Look at the definitive agreement. It's heavily structured with earnouts. MasterCard is hedging its bets.
Typical payments playbook. But I'm still shocked by the price tag. Speaking of price tags, that shocked me, but in the opposite direction. Allbirds.
Oh, the tech bro uniform.
Exactly. American Exchange Group scooped them up for $39 million.
Wait, really? Just 39?
$39 million. I used to build pitch decks for consumer IPOs. They were valued at over $4 billion at their peak. That's a 99% haircut.
You can't wear a wool shoe in the rain, Nate. The market finally priced in the weather.
Cruel, but fair. And if you want more consumer brand drama, the grocery aisles are buzzing. Whispers are getting loud that Unilever and McCormick are nearing a merger.
Now that's interesting. The Spice King meets the Soap King. But I need to see the term sheet before I buy that narrative. What else do you have?
Mundys is tightening its grip on the Channel Tunnel. They just bumped their stake in Getlink to 19%.
Right, the Italian infrastructure operator.
Yep, they're waiting on regulatory approval this April to grab another 6%. It's classic infrastructure creep.
I completely disagree on calling it creep. It's incredibly disciplined capital allocation. They're averaging in while interest rates are finally predictable. It makes their debt modeling actually work.
Disciplined? Oh, come on. It's a hostile takeover in slow motion. They just don't want to trigger a mandatory offer yet?
Both things can be true.
Fair enough. But these are just the appetizers. If you want to talk about capital allocation, we need to talk about the Q1 numbers.
$813.3 billion in total US deal value.
Up 50% year over year, while actual deal volume dropped 22%.
Fewer deals, but massive checks.
Exactly. We are officially in the era of the Megadeal. And nothing proves that more than Paramount and Warner Brothers Discovery smashing their empires together for $170 billion. The big one.
$813.3 billion in a single quarter. I had to refresh the terminal 3 times because I thought the data feed was broken.
Deal volume is actually down 22%, but the total value is up 50% from last year. We are officially in the era of the Megadeal. The middle market is completely frozen, but the whales are starving.
Starving is the right word. Look at the Paramount and Warner Bros. Discovery merger. $170 billion. Nate, they're just mashing 2 leaking ships together and hoping it makes a submarine.
Oh, come on. It's a brilliant defensive play. You have predictable interest rates right now. Market analysts are saying that means you can finally model the debt accurately. They know exactly what this costs.
Knowing the cost of the iceberg doesn't stop the Titanic from sinking. Have you looked at the overlapping assets? Who actually wins here? It feels like the bankers win, and the shareholders get a decade of integration headaches.
The market wins. You secure market dominance. Plus, the regulatory environment is finally thawing. A year ago, the FTC would have laughed this out of the room. Now, as long as they can pitch it as a national strategic asset to fight off international tech monopolies, it sails right through.
Thawing environment or not, I read the footnotes on the synergies. They're projecting billions in cost savings that entirely rely on firing middle management across 3 continents. I'll believe it when I see the quarterly earnings in 2028.
Spoken like a true skeptic, but you have to admit, corporate titans are hoarding the board right now. It's a land grab.
A land grab where half the land is underwater.
You're just mad because it makes your beloved middle market tech deals look like rounding errors. Speaking of rounding errors, did you see the Allbirds price tag?
$39 million. American Exchange Group scooped them up for $39 million.
Remember the billion-dollar IPO days? The fleece vests on Sand Hill Road were treating wool sneakers like they were the next Apple. Now they traded for the price of a mid-tier Manhattan penthouse.
It hurts, but it perfectly captures Q1. You either merge for $170 billion or you sell for parts at $39 million. There is no middle class in M&A right now.
Exactly, and the whales aren't done eating. The grocery aisles are buzzing with whispers about Unilever and McCormick.
The Spice King and the Soap Giant. That would create an absolute behemoth.
We're tracking that one closely for Q2. But before we get to the consumer goods bloodbath, we need to talk about MasterCard.
Right, $1.8 billion for a crypto startup. I found some very creative accounting in the BVNK deal sheet that we need to unpack. Voices.
So these market analysts are running around declaring 2026 the official year of the Megadeal. And honestly, Maya, looking at the Q1 numbers, I have to hand it to them.
Well, the math is staring right at us. Overall volume is actually down 22%, but value is up 50% to $813.3 billion. It's literally just fewer, much fatter deals.
Exactly. And the consensus from regulatory watchers is that we're in a quote-unquote thawing environment. They claim deals demonstrating national strategic value are facing significantly less resistance.
Oh, come on. Less resistance? I completely disagree with that narrative. Regulators aren't thawing. The deal makers are just getting smarter about how they frame the paperwork. Look at that $170 billion Paramount and Warner Brothers Discovery monster.
You think they just slapped a strategic sticker on it?
Yes, that was an army of lawyers writing a bulletproof brief on why they had to merge to survive against big tech. It isn't a thaw. It's better corporate theater.
Spoken like a true skeptic. But you can't ignore the debt markets. Predictable interest rates finally mean my former banker friends can build debt models that don't look like total fiction. It gives firms the confidence to swing for the fences. Just look at MasterCard dropping up to $1.8 billion on BVNK.
Sure, the debt modeling is cleaner, but not everything is a confident mega deal. Did you see the Allbirds buyout?
Oh man, scooped up by American Exchange Group for a mere $39 million.
$39 million for a shoe company that went public at a valuation over $2 billion. I read that press release and actually gasped. It's basically the price of a luxury penthouse in Manhattan for an entire public company.
The sustainable shoe bubble officially popped. But speaking of potential bubbles, the grocery aisle gossip is getting extremely loud.
Right, the Unilever and McCormick whispers.
A global food behemoth in the making. We're going to be watching to see if that officially materializes as Q2 kicks off. Plus, we have our eyes on the European infrastructure space.
Exactly. Mundys is waiting on imminent April approval to grab another 6% of Channel Tunnel operator Getlink. We'll be tracking both of those very closely. Spill the tea.
I am just saying, $39 million for Allbirds. I've seen seed rounds for crypto wallets raise more than that.
You are exaggerating, but barely. Remember their IPO? They were valued at over $2 billion. $2 billion for wool shoes that smell like a wet dog when it rains.
Hey, I owned 3 pairs. They were the official uniform of venture capitalists for a solid 18 months.
Keyword is were, which is why American Exchange Group paying $39 million isn't some brilliant steal. It's a salvage operation. They basically bought a customer mailing list and a warehouse full of unsold merino slip-ons.
I completely disagree. $39 million is absolute pocket change for a brand aggregator. You take the Allbirds logo, slap it on some cheap mall kiosks, and you make your money back in 2 years. It is a textbook distressed asset play.
Or you just burn $39 million. But fine, let's move from micro to macro. The grocery aisles are leaking.
Oh, this is my absolute favorite rumor of the week. Unilever and McCormick.
Right? The maker of Hellmann's Mayo wants to buy the Spice King.
Think of the synergies, Maya. Old Bay mayonnaise. It practically writes itself.
Please never say those words again. But seriously, look at the scale. Unilever buying McCormick would create an unstoppable behemoth in the center aisles of every supermarket.
It perfectly fits the Q1 Megadeal narrative. If you have the balance sheet, why buy a niche organic brand when you can literally buy the entire spice rack?
I just want to see if regulators actually let them build a condiment monopoly. We might find out soon. The whispers say an official announcement could drop as Q2 kicks off.
Which reminds me, consumer goods aren't the only ones waiting on regulatory green lights this April. We need to talk about Italian infrastructure operators trying to buy the Channel Tunnel. Tomorrow's radar. Tomorrow morning, I'm refreshing my terminal at dawn for this Unilever and McCormick rumor. If they actually announce, that is the consumer goods mega deal of the year.
You're obsessed with this spice merger. I still don't buy it. The antitrust headaches alone. Come on.
Regulators are thawing Maya. Predictable rates mean the big boys are back to playing Monopoly.
Thawing for national strategic value, maybe. Mayonnaise and garlic powder don't count as national security.
Tell that to my sandwich.
What you should actually watch tomorrow is European infrastructure. Mundys is expecting regulatory approval to grab another 6% of Getlink.
Yes, tightening the grip on the Channel Tunnel, because nothing screams sexy M&A like a train under a cold ocean.
It's highly strategic. They're creeping up to a 19% stake. That is how smart money moves. Quietly, while everyone else is staring at the spice rack.
Fine, I'll watch the tunnel, you watch the spices, we'll see who has a better morning. Talk to you tomorrow.